Have you ever had that feeling, that your investments are basically just a gamble? That you're not really in the driver's seat? Well, today, we're going to pull back the curtain on a world where some of the most sophisticated investors are doing things differently. A world where they are taking back control. It's called private credit. We're going to dig into why it's becoming so popular and what it really means to have your hands on the wheel of your own financial future. Let's get into it.
So here's our roadmap. We're going to start in a really familiar place, the public markets, what most of us think of as investing. But then we're going to start to see the cracks in that foundation, which leads us down an alternative path into private finance. After that, we'll open up the operator's manual, look at the tools of the trade, and finally, we'll talk about the one asset that unlocks this entire world. All right, part one, the default world. Before we get into the wild stuff, we've got to set the stage. For pretty much everyone, investing means the public markets. And really, it all boils down to two fundamental choices you can make. First up, you've got the stock market. You know this one. When you buy a stock, you're buying a tiny piece of a company. You are an owner. Now, the upside is huge, right? You get a slice of the profits, a piece of the growth. But the downside? Well, if that company goes belly up, the owners are the absolute last people to get paid, if there's anything left at all. Okay, so the other side of that coin is the bond market. With bonds, you're not an owner, you're a lender. You are loaning your money to a company or even the government, and they promise to pay you back with interest. Think about it this way. You're not betting on a company's incredible, world-changing potential. You're just betting on its ability to pay its bills. And here's the crucial difference. If that company goes bankrupt, the lenders, the bondholders, they get their money back before the owners even see a penny. So let's just nail this down. Being an owner, equity, it offers a shot at massive growth. It's like a rocket ship, but it carries this huge risk of being last in line if the whole thing blows up. Being a lender, debt, it's more like a treasure chest you fill up over time. It's predictable, steady returns, with the safety of knowing you have a stronger claim on the money. Owner versus lender. This is the basic choice in the public markets. Okay, on to section 2. Now, if investing was really that simple, why would anyone bother looking for an alternative? This is where things get interesting. This is where the cracks start to show and where the search for something that feels less like a casino and more like control really begins.
And this is the million-dollar question, isn't it? You can do all the research, you can pick what you think are the absolute best companies or the safest bonds, and you can still feel like you're just a passenger on a giant ship being steered by somebody else right into a storm that you can't even see coming. So why's that?
Just think back to the 2008 financial crisis. It wasn't just a few bad stocks going down. The entire system felt like it was about to implode. And people who had done everything right, saved their whole lives, they watched their retirement accounts just evaporate. And the core reason for that pain? A complete and total loss of control. Their money was trapped in a machine driven by forces way, way beyond them.
And look, this wasn't just a problem for everyday folks. Even Warren Buffett, probably the greatest investor of all time, he couldn't escape it. From the middle of 2008 to early 2009, his company Berkshire Hathaway lost a staggering 40% of its value. That's what we call systemic risk. It's a massive tide that lowers all the ships, and it proves that in the public markets, nobody is truly safe from the storm.
So if we're not steering the ship, who is? Well, a huge player is the central bank. In the US, that's the Federal Reserve. And they have this toolkit that can influence the entire economy. They can lower interest rates to make borrowing cheaper. Or they can use this other tool with a really fancy name, quantitative easing, or QE. Now, if you strip away all the jargon, this is basically the Fed creating new money out of thin air to buy up government debt, which pumps cash directly into the financial system to keep it from freezing up. And if you think that sounds a little crazy or abstract, just listen to what former Fed Chairman Alan Greenspan once said. He said, "The United States can pay any debt it has because it can always print money to do that." Just let that sink in for a second. The very foundation of our currency is a promise that can be diluted whenever they decide to. This is a massive, systemic force that affects the value of every single dollar you have, and you have exactly zero say in it. And the consequences of this became crystal clear in 2011 when, for the first time in history, the US government's credit rating was actually downgraded. And the reason they gave? Political risks. All of a sudden, the world's quote-unquote safest asset came with a warning label. This, right here, is the ultimate lack of control. Your savings are literally subject to the whims of politics. So that's the problem, right? You're in a system where you can do everything right and still get wiped out by forces totally outside of your influence. And that brings us to part 3, the alternative path. This is about stepping outside of that system entirely and finding a world where you can actually put your own hands on the wheel.
So what even is private financing or private credit? Well, it can take a lot of forms, but let me give you a perfect, simple example. Seller financing. So instead of a buyer going to a big bank to get a mortgage for a house, the seller of the house becomes the bank. The seller provides the loan directly to the buyer, and in doing so, they convert their property, their equity, into a steady stream of income from the loan payments. It's a direct deal, just two parties, cutting out the giant institutional middleman. And that is the heart of private finance, creating your own terms.
Now, for the person buying, the advantages here are just massive. You can forget about the bank's rigid one-size-fits-all rulebook. In this world, everything is negotiable. Imagine being able to structure a deal where for the first couple of years you only pay interest. That gives your new business or rental property time to start making money. You can't just ask for that on a bank's website. And a seller might look at your character, at the asset, not just your credit score. And hey, if you hit a rough patch down the line, you get to have a real conversation with a human being, not some faceless institution.
Okay, but what's in it for the seller? This is where it gets really cool, because it's a true win-win. First off, they can often sell their property faster and for a higher price. They can get some pretty significant tax advantages too. But here's the big one. They transform a static asset, like a house that's just sitting there, into an income-producing machine that pays them every single month. They've essentially just created their own private bond, one that's tailored exactly to their own needs.
So we see what private financing is. We see why it's so compelling. Now it's time for part 4, the operator's manual. This is where we get practical. We're moving from the what to the how. What's the mindset? What are the actual tools you need to have in your toolkit to think and act like a private investor?
Okay, the single most fundamental shift is what you focus on. So many investors in the public markets are chasing what we call capital gains. They buy low and they pray they can sell high. It's all about speculating on the future price. The private investor, on the other hand, is completely obsessed with cash flow. They buy or create assets that produce income month in and month out. The goal isn't to guess the future, it's to build a predictable, reliable income stream today.
The source material we're looking at today is really blunt about this. It says, in most cases, investing for capital gains is gambling. I mean, just think about that for a second. When your entire strategy depends on predicting what millions of other people are going to do with their money in the future, how is that really any different from placing a bet at a casino? Focusing on cash flow, though, that's about the real, tangible performance of the asset itself. All right, the next tool in the manual is how you think about debt. A lot of us are taught to be afraid of debt, but sophisticated investors, they see it as a powerful tool. It can be used for good or for bad. So bad debt is consumer debt. Using a credit card to buy something that loses value, which you then have to pay back with your own hard-earned money. But good debt, that's when you use it to buy an asset that generates more than enough income to pay for the debt itself. It's debt that actually puts money in your pocket. That's real leverage.
Okay, now for a word that tends to scare a lot of people, derivatives. But I promise you, the concept is actually incredibly simple. A derivative is just a contract that gets its value from something else. The best analogy I've ever heard is car insurance. Your insurance policy is a derivative of your car. You don't own a second car, you own a contract that protects you from the risk of a crash. Well, in the financial world, derivatives can be used in the exact same way, as a form of insurance to control your risk. It's that simple.
And managing risk is the whole name of the game. A sophisticated investor sees the entire landscape of risk. Yeah, there's systemic risk, those big market-wide storms we talked about, but in a private deal, you have these very specific risks that you can actually get your arms around and manage. Like credit risk. What happens if the person you loaned money to stops paying? Or purchasing power risk. What if inflation just eats away at your returns over the next 20 years? Understanding these isn't just important, it's crucial.
But, and this is so important, these risks aren't just things you accept. They are things you actively manage. The antidote to credit risk? You do deep, thorough due diligence on the borrower and on the asset. But the ultimate tool, the real game changer, is control. You structure the deal, you manage the asset, you build in your own protections. It's all about making that shift from being a passive passenger to being the pilot of your own plane.
And that brings us to our final section. We've talked about the public markets, the private alternatives, the mindset, and the tools. But underneath all of that, there is one thing that matters more than anything else: your single most valuable asset.
Here's the most crucial point of all. The best deals, they're not just sitting out in the open for anyone to grab. They are often reserved for people who actually understand the game. The source material says it perfectly. The more sophisticated I get, the more opportunities come my way. Your financial education isn't just some academic exercise. It is literally the key that unlocks the door to a completely different level of opportunities.
And so let's end on this final thought. The public markets are designed to be easy. They're waiting for your money. You can log on and invest in 10 seconds flat. But the private opportunities we've been exploring today, the ones built on control, on cash flow, they aren't waiting for your money, they're waiting for your knowledge. So the real question is, which one are you going to cultivate first? Thanks for tuning in.